Okay. So this financial independence, obviously it is about money, okay, and investments. So what is actually financial independence? Financial independence means when you when you collect an investment corpus, and if the investment from this investment corpus, income from investment corpus is more than your expenses, then you are financially independent, because most of us work for money, and if and this money is required for daily sustenance. So if this is going to come from investments, you really don't have to work. So your dependence on money for your day-to-day expenses is taken care of, and you are financially independent. So the two things here, one is like we are talking about income generated by your investment corpus. So we are not talking about like taking money out from investments. It is the income that is generated from this corpus. So there are two things. One is investments, and the other is expenses, which also need to be controlled if you have to achieve this financial independence at an early age. Okay, so there are two components to this. One is investment and other is expenses. So when it comes to investments, our focus should be to generate more income. And when it comes to expenses, it should be to get more value out of every penny you spend. Okay. So there are two things, investments and expenses. And in today's session, we are primarily going to discuss on investments. Actually, this fire, as such, it is a very big subject, and it actually involves like change of mindset, change of behavior. So we are going to take only a very small portion of this, which is primarily investments. Okay. So if you make your money work smarter, then only you will be able to achieve this financial independence at a very early age. So let us understand what is investment. So what is investment? Investment is all about managing money. So when you think about money, what all things uh, what all things come to your mind? What is the use of money? Let us make it interactive. You can say like, what is the use of money?
Of course, to
Yes,
spend on our needs, whatever our requirements are for
yes,
education, for buying, for your livelihood.
यार ऊपर रखो,
So many
दर्द हो जाएगा उससे हिप से पूरा रखो।
right. आंचल जी, आप कुछ बोल रहे हैं?
नहीं नहीं वही spend on things we like, we want to do when we get
Yeah,
older.
I have listed couple of things. Anyone wants to add?
Yeah, your daily expenses, food,
Right.
clothing, your entertainment.
Yes. Actually, I'm looking for a very specific answer, and
Yeah,
so far I haven't got that answer.
it is planning for future also, Viraj. Planning for future and if I may
Right.
call
You're very close. Okay.
yeah,
I
retirement
think
or post planning for
yes.
the future. Yeah.
Yeah, when we are
Right.
not working, we shall get the
Yeah, exactly,
money to
exactly.
spend.
Yes. Okay. So actually, this was the answer I was looking for.
Make more money.
Use of money to make more money.
Oh,
Okay. Whatever else that we talked about, most of it was expense oriented, like use of money to spend on something. Okay. But this is one use which one must remember all the time, that money can be used to make more money. And that is what is investment. Okay. And why do you want to make more money? Like some of these we discussed, like fulfill goals. All of us have goals like buying a car, buying a house, taking a vacation. Okay. So one needs to make more money to fulfill these goals and dreams. And most important is achieve financial freedom. So if you use money judiciously, you will be able to achieve financial freedom at a very early age. Like you don't have to wait till legal retirement age to retire from job. Okay. So this is about use of money, and we saw that use of money to make more money is investments. So now let us try to understand what actually is investment. So investment actually means that any enterprise or even government needs money. An enterprise needs it to run its business, to expand its business. Government needs money to build infrastructure. Okay. So suppose I am a entrepreneur and I need money. So some part I will invest from my own, but I need lot of money in order to expand my business. And there are two ways in which I can take this money from you. Now, as an example, I am a businessman and I want to take money from you to expand the business. So there are two ways in which I can take money from you. One is like a loan. Like I take the money as a loan, and I like when I take a loan, the terms are fixed that the loan is maybe for 10 years. Every year I will give you 7%, and after 10 years I will return your money. So this is like a loan. And as I said, I am a businessman. So like business can generate profit, it can get into a loss also. So when I take money from you as a loan, and since it's a business, suppose first 2-3 years, it doesn't make much profit, or maybe it is in loss. So in these years, I cannot say that since I am making a loss or very less profit, I won't be able to pay 7%, I will pay only 2%. Okay, I cannot say that because the terms are fixed. And suppose from 4th year or 5th year onwards, business starts making bumper profit. So that time you cannot say that you are making 15% but giving me only 7%. You should pay me more. Because the primary characteristic of this type of investment, which is loan, is you don't want to get involved with the risk of my business. You say like whether you make profit or loss, it is none of my concern. I need to get my fixed income, which is agreed in the beginning. So you are not willing to take any risk of the business. So which means low risk, or we can say no risk, because you are not willing to take any risk of the business that I am running. So in this type, since there is no risk, the returns are average. Okay, so this is the first type of investment, which is fixed income, or it is also called debt securities. So when you open a bank FD, you are actually giving a loan to the bank. Okay, so this is first type, no risk, so average, or I would say poor returns. Then second is where I take money from you and I say, from today you are my partner. Okay, so in this case, since it's a business and both of us are partners, there is no commitment for anything. There is no commitment for interest, and even no commitment whether I will return the money back to you. Okay, so this is part ownership, and this is called stocks or equities. So when I buy one share of Reliance, I am a owner along with Mukesh Ambani. The only difference is like my stake is some 0.0000 whatever percentage. So if Reliance makes profit, both me and Mukesh Ambani, both of us benefit. But if it doesn't make much profit, both of us like have to bear with it. So this is part ownership and it is stock. And here, in terms of risk, I am willing to take the risk of the business. So if business doesn't do well, I am okay to be contained with lower returns or maybe negative returns also. If business does well, I will get my profit. So this is a high risk proposition, which is second type of investment. It is called equities. So when I'm willing to take higher risk, the risk of business, there is only possibility of higher return. Okay, any questions on this? Okay, so these are two types of investment: fixed income, low risk, so poor returns. And then there is the second type of investment, equities, which carries a high risk and there is only a probability of high return. In first case, when the interest of the loan is 7%, it cannot become 6.99. That's why it cannot become 7.01 also. It is fixed 7%. Whereas in equities, there is no guarantee. So it can be negative 5% or it can be positive 10%. It can go any way. And that is what is high risk. And that's why there is a possibility of higher return. Okay. Now, when people hear this word risk, they get scared actually. So somebody who listens to this, he will say, I don't want any risk. I want to invest my entire money in first type where there is no risk. But in life, you cannot like avoid risk. You have to take risk. But when you take a risk, you need to understand what kind of risk you are taking, and you need to have mitigating actions. So here we are talking about risk of an investment. So we need to understand what is the risk of an investment. So there are only, risk and returns are the two sides of the same coin. So if you want higher returns, you have to take higher risk. There is, if somebody comes to you and says there is absolutely no risk in this, but returns are high, that is actually a con game. I mean, you need to stay away from this because it cannot happen that there is no risk, but returns are very high. So let us try to understand what is the type of risk. So we have discussed two types of investments. Now we are going to discuss three types of risks. So what is the first risk? And this I am talking about any investment. So the first risk of any investment is losing all the money. And everybody understand this. I invested in some product and I lost all the money. So this is the first risk. Second risk is returns less than expected. So I wanted higher returns, so I invested in equity. But in the end, it turned out that my returns are less than even bank FD. Okay. So this is the second risk. Your returns are less than what you expected. And then what is the third risk? Third risk is volatility of returns, which means first year I got 5%, second year I got -2%, third year I got 10%. So all over the place. So there are three risks of any investment: lose all the money, returns less than expected, and volatility of returns. So far we have discussed two types of investment: fixed income and equities, and we discussed these three risks. So now what we will do, we will try to see these two types of investment, like which risk applies to each of these. So two types of investment, three types of risk. Anybody has any comments or have any questions? Feel free to ask. Okay. Okay.
All
So
good.
okay. So we will see investments and the risk. So what is the first type of risk? Lose all the money. And we have discussed two types of investments: fixed income and equity. So this first risk of losing all the money, does it apply to fixed income like bank FD? Yeah, please answer. Anybody?
No, it doesn't apply.
Very good.
Yes, it is fixed income. No, you have deposited in a bank because it is a safe as much as we know.
Right. You are right. Okay. This is second. Okay. Sorry. Okay. So when you come to fixed income, the risk doesn't apply. What about stocks or equity?
Yeah, you can lose all money.
Yes. So the risk is yes.
Yeah.
Okay. Second type of risk, returns less than expected. So does it apply to first type?
No.
No. What about second?
Yes.
Yes. Now third risk, volatility of returns.
No.
No. Equity,
Yes.
very much. Okay. Okay, so that means like we have two types of investment. In first type, that is fixed income, none of the three risk exists. So we can say no risk. But what do you get? You get poor returns or average returns. Whereas there is other type of investment, equities, which is exposed to all three risks. And what do you get in return? Only a possibility of higher return. It doesn't, by taking all three risks, it doesn't guarantee higher returns. If it guarantees higher return, then there is no risk actually. Okay. So are there only two options which are like diametrically opposite? One is fixed income, where there is zero risk, so returns are low, and the second equities, which is exposed to all three risks, and there is only possibility of higher return. So ideally, how do we invest? Because there are two diametrically opposite options that we have. So where should we invest? Fixed income or equity? Any comments on that?
If we don't want to take risk, as you said, without thinking of taking any risk, then we go for fixed income.
Yes. But like you know, I already told you about
yes,
like drawback of fixed income.
yeah, drawback
You
is
have to be content with low returns, and the returns can be as low as sometimes it may not like even cover the inflation.
yes, that is very true. But when we say no, if we want to play safe, then go for fixed income. And when we want to take risk, then we need to gain knowledge and then play like
Right.
in cricket.
Right, absolutely right. So what we are talking about is like mix of both. Okay, some amount of money in first type, some in second. Okay, so how does one decide this proportion? And that is in investment terminology, it is called asset allocation. How much you allocate to first type, how much you allocate to second type. Okay, so like if you want definition, it is an investment strategy to optimize risk and return of an investment basket based on investors' risk profile. Okay, so the main thing to be considered is every investment has a risk profile or risk taking ability. And based on that, one should decide how much percentage should go in first type and what percentage should go in second type. And this is called asset allocation. So since it depends on investment risk appetite or risk profile, there are four factors on which the risk tolerance depends. Any investor has this risk tolerance capability. The first factor which determines this is age. So if you are young, you have a long working life ahead of you. So you may not be really dependent on the money that you are investing. So when you are young, you can take higher risk. Whereas somebody who's close to retirement or already retired, he can take low risk. So age is the first factor. Second is assets and liabilities. which means if somebody is young but he has already taken a lot of loan, vehicle loan, housing loan, then even though age is on his side, he should not take much risk. Whereas somebody who is close to retirement has already built assets, has no liabilities, he can take more risk. So this is the second factor. Third is investment time horizon. So how long you are willing to stay invested. So if you are willing to stay invested for less than 2 years, then you should avoid the risk of equities. But if you are able to stay invested for a long duration, 3 years, 5 years, 10 years, then you have a risk appetite to invest in equities, and we will see what is the reason for that. Right now, just remember that if your investment horizon is short, then your risk taking ability goes down. Okay. And the fourth factor is inherent nature of an individual. Like some people are very conservative by nature. So if they invest in equities, they may lose sleep because stock market is going to go up and down every day. So if that is the nature, then even though all these factors are in your favor, you should not take more risk. So this risk tolerance or risk taking ability depends on these four factors. And based on these four factors, one can come up with risk taking ability. And based on that, one can decide the percentage between first and second. Okay, so that is about asset allocation. So now, like I have told you, what is fixed investment, fixed income investment, what is equity. So will you be able to invest on your own? Because when it comes to fixed income, there are thousands of options. So how do you decide? When it comes to stock or equities, again there are thousands of options. So in spite of getting all this knowledge, you will not be able to invest on your own. Okay, and that's where mutual fund come into picture. This is for people who may not have the knowledge, and some may have knowledge but not time to like really study all this. So for such investors, there is mutual fund. So what mutual fund does is it pulls in money of small investors, which makes into a big corpus, and that corpus is invested on behalf of investors, and whatever returns are generated, whatever profits are generated, they are equally shared among the investors, and that is what is mutual fund. And like how do they invest? Like every mutual fund has an objective. So for example, like a fund which is launched as a fixed income fund, its objective is not to invest even a single penny in stock and invest everything into fixed income products. So that is the objective of that fund. On the other side, equity, like when a fund is launched as an equity fund, its objective is to invest entire corpus into stocks. Okay, so when you actually like the fund, every fund has a fund manager. So fund manager is not going to ask you how to invest. Fund manager goes according to the objective of the fund. And what you have to decide is you have to decide your objective and select a fund which matches your objective. So that is the basic funda of a mutual fund, because there are so many mutual funds, maybe thousands, 5,000, 6,000, I don't know. So one may get confused as to where to invest. So what is important is for you to decide the objective of your investment. And when I say objective, you have to decide whether you want to take risk or you don't want to take risk. So choose the fund as according to your objective, fixed income or equity. So as I said, like money of small investors is pulled in. And like mutual fund provides solution to all your investment requirements. Like I already discussed about fixed income and equities, but there may be some people who want to invest in commodities. Like nowadays, gold and silver is very much being talked about. So if you think silver is going to appreciate even from these levels, and you want to invest in silver fund, then there are mutual funds which don't invest any penny in fixed income or any penny in equity. They invest the entire money into silver. There are funds which invest entire money in gold. Okay, so that is the third type of fund which you can say commodities. And their objective is to invest in a particular commodity, either gold or silver. So as I said, it provides solution for all needs. Like in addition to these three, there could be other investment needs also. Somebody wants to invest only in Chinese stock market. Then there will be fund whose objective is to invest only in Chinese stocks. Somebody thinks that BRICS is going to do well. So there can be there are actually BRICS funds also, US funds. So whatever is your investment requirement, there is a fund which will take care of that requirement. So what is the benefit? You get benefit of specialized knowledge. Like as I said, every fund is managed by a fund manager, and he is a professional fund manager who's well qualified and whose job is like he is on to full-time job of managing the investment corpus. So at a very small expense cost, you get benefit of a specialized knowledge fund manager. The cost, as I said, is very, very low. And for such a low cost, you get benefit of a specialized fund manager. Then you get benefit of diversification. Suppose you have 5,000 rupees and you want to invest in stocks. How many company stocks you will be able to buy from that 5,000 rupees? Maybe 4 or 5. Okay. So your entire performance of investment depends on only a few stocks when you invest yourself. But when you invest through mutual fund, mutual fund will buy stocks of about 30 companies. So you get benefit of diversification even with a small amount of investment. The liquidity is very high. When it comes to investment, we should also be concerned about liquidity, which means when I need money, how long it takes to get my money back. And in case of mutual fund, in just 1 or 2 days, you will get your money back. There is a lot of flexibility. Like all these mutual funds are perpetual schemes. So the funds are there. People keep putting money, people keep taking out money, but the fund is always there. It is a perpetual scheme. What is the flexibility? You can invest, if you have lump sum, you can invest only once and forget about it. Your money will grow along with that fund. Only one time investment you can do. Or if you want to invest your future income, like for those salaried people, every month there is a salary, they have a salary, and then there is disposable income. So you can decide that every month I want to invest this disposable income, so that you can set up a monthly investment plan. And it is very popular now. It is called SIP, systematic investment plan. So you can invest on a monthly basis, or you can make only one time, or you can have a combination of both. Like you can start a SIP where every month some money is invested and you may get a bonus or something. So that time, if you want to invest, you can invest that lump sum also. The other flexibility is you can withdraw anytime. And when you withdraw, you have you can withdraw partially. Like if your corpus is say 10 lakhs, you can just take out 5,000 rupees, or you can take out entire thing. The option is you have both the options. So you can withdraw anytime. It is highly tax efficient. I won't say it is tax free, but it is very much tax efficient compared to other types of investment. And people who are afraid of fraud and all, there is comprehensive regulation and transparency. So regulation in terms of, as I said, the fund has an objective and it has to invest as per its objective. So a fund which calls itself fixed income cannot invest in equity. So that's why there are quarterly audits to make sure that the fund manager is investing as per the objective, and there is also transparency. Like when you invest, you are allotted number of units, and this unit has a value. So when you invest on a particular day, the amount you invest, the units that you will get is based on the value of that unit on that particular day. And this unit value is declared on a daily basis and quarterly, like the entire portfolio of the mutual fund is disclosed. Okay, so there are comprehensive regulations and transparency. Okay, this is what NAV, that is net asset value of the unit. So it is declared daily and the entire portfolio of the fund is declared quarterly. So, okay, like now we have understood two types of investment, three types of risk, and we have also understood what is mutual fund. And when we discussed about investments and risk, what we have concluded was that there are two types of investment, one low risk or zero risk and returns are low. Second is high risk, very high risk. In all three, it ticks all three risk categories, but there is only a probability of higher returns. So we were looking at something in between. So mutual fund is something which is in between. Let's see what it is. Okay, so we are talking about the two types of investment in addition to that, mutual funds. So we will evaluate the risk in this third category. Lose all the money in when it comes to fixed income, we said there is no such risk. Equity, it's there. Now, what about mutual fund? Does it carry the risk of losing all the money? Hello, take a guess.
No, no, no.
Okay, your answer is right, but why do you say that? You know a reason?
But just now you said mutual funds, either you gain something or you gain less. It is not total loss at all because the
Okay, I'll tell
investments
you
are
the
of
reason.
three types.
I'll tell you the reason. See, when it comes to equity, as I said, you will be able to invest in very few stocks if your investment amount is less. So, as I said, your performance of the investment will depend on these few stocks. So, if these two, three stocks like they become zero in value, the company folds up, you will lose all the money. That's why when it comes to equity, we said yes, you can lose all the money. But I also said a mutual fund invest in stocks of some 30 to 35 companies. Okay. So if you have to lose all the money, what should happen? All these 30
Some place
companies
has to close down or
has to close
something
down.
goes wrong with them.
And that too at the same time.
Yes.
So what is the probability? The probability is zero. So when it comes to mutual fund, okay. Okay, so when it comes to mutual fund, this risk is losing all the money is not there. Okay, what about second, returns less than expected? We said it is not there in fixed income, it is there in equities. What about mutual funds? Like you invested in an equity mutual fund with the expectation that you will earn much higher than bank FD. Now, what is the risk that this expectation may not be met? Is the risk there or no?
Yeah, risk is there.
Yes. But I would say yes and no, both. The risk, I already said that. The risk is there if you invest for a short duration. If you invest for 2 years, then your returns may be less than bank FD. But if you invest for a long duration, 3 years, 5 years, then this risk is not there. So this risk depends on the investment duration. Okay. And third, volatility of returns. Fixed income, it's not there. Equity, it is there. What about mutual fund? Yes, Venkatesh, you know this very well.
There is volatility
Yes.
because it is
The
linked.
third risk is there, basically. Okay, so we have found something in between, mutual funds, which reduces the risk and at the same time, like it can generate much higher returns than bank FD. So mutual fund is something in between. And in addition, it carries lot of flexibility and we already saw a lot of advantages. So mutual funds is a way to go if you don't understand these investment concepts and neither you have time, but you want to generate good returns, then you should go with the mutual funds. So now you have understood this and suppose you have decided to invest in mutual fund. So what are the ways of investing? One is I have money right now. That means I have lump sum amount. So how does one invest? Like with this lump sum, I can take a risk because my investment horizon is more than 3 years. But if you invest lump sum in one go, as I said, market is volatile. So suppose in 6 months, market comes down by 10%, you have lost 10%. So if you want to reduce this risk, what you can do is put the entire money is fixed income and periodically keep switching from this fixed income to equity. And mutual fund provides a mechanism for that, which is called systematic transfer plan. So automatically on a particular day, the money will be moved from fixed income to equity. So market is volatile. So you are reducing the risk and at the same time, you are taking advantage of this volatility. Like when the market is down, with the same amount of money, you will be able to buy more number of units. And when the market is high, obviously the unit value of the fund is high, so you will buy less number of units. So after a period, this works in your favor. So this
How
is how.
sorry, how do we know, Virajji? How do we know like when to switch and all that?
See, one is auto mode because
Hmm.
we don't know like where the market will be tomorrow or 1 week from now. So it is
Right.
just an mode. Like you say
Hmm.
on 10th of every month, my money should
Hmm.
switch from fixed income to equity.
Hmm.
Okay, you are only staggering the investment. You
Hmm.
are even though you have lump sum right now, you don't invest entire money into equity in one go and
Hmm.
then get exposed to the risk of volatility.
Hmm.
Okay, you understood?
Yes.
Yeah. Okay, and then other is like I have a salary and I have disposable income every month. So then you do SIP, systematic investment plan. You set up a plan that every month on a particular day, a fixed amount of money should get invested. So this also like uses this volatility to your advantage because every month market is going to go up and down. And as I said, if market is up, unit value is high, so with the same amount of money, you will buy less number of units compared to when the market is down. So when the market is low, you buy higher number of units. When market is up, you buy less number of units. And you can have a combination.
Uh,
Okay, you can have
I have a
yeah.
question here. समजा माझे SIP 10 तारखेला डिडक्ट होते.
Hmm.
ओके. कुठल्याही याच्यात म्युच्युअल फंड मध्ये मी घेतलेले आहेत. पण त्या तारखेला जेवढी व्हॅल्यू असेल तेवढेच मला फंड्स मिळणार ना?
Yes. So that's what I'm saying. Markets are वर असेल ना, the unit value will be higher.
ओके.
So you have 10,000 and the values, let us say, is 15, then like you have like in your SIP is 10,000. So 10,000 divided by 15, you will buy those number of units. When the market is down, the value may be 12 rupees. So 1000 divided by 10,000 divided by 12, you will buy more number of units.
ओके.
So when market is high, you buy less number of units. When market is low, you buy more number of units. And ideally, what we would like to do when the market is high, we don't want to buy at all. And when the market is low, we want to put our entire money. But that is only theory. You cannot do that.
करेक्ट.
Yeah. So that is the advantage of SIP. So you know how to invest. Now the next question is, what is the right time to invest? So this is the graph of Bombay Stock Exchange Index for a 6 months period. Yeah, almost slightly more than 6 months. So market, like if you can see the graph, it fell by about 40% in just 3 months. And then it went up and it even surpassed the initial like 40,000 level, and it went up to 48,000 in another 6 months. Okay, so when you are looking at a short term, this question can be answered: when to invest? Okay, it's valid only when your investment horizon is short. Okay, and this is like some statement by Marilyn Monroe. I don't know in what context. If you cannot handle me at my worst, you don't deserve to benefit from my best. And according to me, this applies to stock market also. Like those people who got panicky when it crashed by 40% and sold off everything, they lost this rally. So if you cannot handle me at my worst, you don't deserve to be benefit from my best. So this is about short term. So if you are thinking short term, then the question is valid as to when to invest. And this is the Sensex journey of 31 years. So you can see this journey, all kinds of catastrophic events happened, but market kept going up. And if you look at this graph, every 3 years, market hits a new top. During those 3 years, it can be anywhere. But every 3 years, it scales a new peak. So if you have to invest for such a long duration, 5 years, 10 years, 15 years, then the question as to when to invest is not valid. Any time is right time. Okay. Okay, and this is just an example. These are not recommendations. Like people think what a SIP of 10,000 per month can do. So this is the actual data of the corpus that is generated by someone who would have started an SIP 10 years back, and the SIP value is just 10,000 rupees per month. And this is the corpus. Like you can build a corpus from anywhere from 33 lakhs to 53 lakhs, just 10,000 rupees per month and just 10 years. So this is how one can go about building wealth with regular and disciplined investment. Okay, these are not recommendations. I have randomly picked up these funds, and every fund carries a
Uncle, this is sorry to interrupt. This is based on the last 10-year return which this funds are giving.
yeah.
Okay.
Okay, and these are some of the things that you should remember, like how you build wealth through SIP. It's through power of compounding. And this is what, according to a simple definition of compounding. Money makes money, that money makes more money, that more money makes even more money, and this continues. And that is what is compounding. So as the inflation increases, one has to remember that there is something called compounding also, which works in the background to like remove this effect of inflation, to take care of inflation. Okay, and like as I said, like taking no risk is actually exposes it to very big risk. This is the statement by Mark Zuckerberg. Biggest risk in life is not taking any risk. Like if you are not willing to take risk and invest entire money in bank FD because it doesn't carry any risk, then you can see for yourself like value of 1 lakh after 20 years. This is from 2001 to 25, so 24 years maybe. So bank FD 1 lakh after 24 years will become 4.3 lakhs, whereas equity fund, the value will be 16.1 lakhs. So if you want a guarantee, then this is what you lose. And always remember, guaranteed returns means low returns. Because if you have to generate higher returns, you have to take risk. So if somebody is giving guarantee, he is not going to take any risk. Okay. Yeah, and like those who are thinking about retirement, this is the most simple and flexible and tax efficient retirement plan. Like in your working life, that is accumulation phase, you build corpus through SIP, the monthly investment. And once that corpus is there, and when it's time to retire, you are not going to have any income to continue the SIP. In fact, like you are going to need money every month. So you can get that monthly income through this SWP, systematic withdrawal plan. Like you have to make sure that you take out money so that the corpus doesn't deplete. So you have an accumulation phase, which is your working period, and you have an enjoyment phase with SWP, systematic withdrawal plan. So this is exactly opposite of SIP. SIP is when you have disposable income and you want to invest that disposable income. SWP is when you don't have any income, in fact, you need income. So you keep withdrawing from your corpus. So SIP and SWP, that is the most simple, flexible, and tax efficient retirement plan. It is very tax efficient actually. Like we can discuss like specific requirements. Yeah. So this is about.
Actually, I should be very thankful to you, sir.
Okay. Hmm.
Sanskriti is stuck up with her friends, so she could
Oh,
not
okay.
join. That is the message. I am stuck up with my friend. Her friend has come back from Egypt just now, so she couldn't join. They share the room.
Okay.
Okay.
Yeah. So any questions?
Yeah, Virajji, I wanted to ask about the tax part that you were talking about, that how is it tax friendly?